Hello and welcome to Unit 4, Connectivity, Intellectual and Human Capital KPIs. This unit will combine a discussion of connectivity with that of metrics related to human and intellectual capital. Connectivity is a core principle of integrated reporting, and it says that an integrated report should show a holistic picture of the combination, interrelatedness, and dependencies between the factors that affect the organization's ability to create value over time. It highlights a few key forms of connectivity of information, including connectivity between financial and other information, the content elements, the past, present, future, the capitals, 6 capitals, and quantitative and qualitative information. In this unit, we're going to focus on the connectivity between financial and other information, and in a later unit, we'll look at the other types of connectivity. This connectivity requirement between financial and non-financial information in integrated reporting is not unique. It is also present in other standards under development in the EU and US. Both require for the reporting of the impact of non-financial information on the financial position of companies. This is the idea of financial materiality. In the last units, we looked at the idea of impact materiality, or the impact of the company on its external environment. Financial materiality is the impact of the external environment on the company's financial position. So in reporting and deciding what is material, under these standards and under integrated reporting, the idea is to follow a concept called dual materiality. Dual or double materiality relates not only to the impact of the company on its external environment, but also the impact of the external environment on the company's financial position. An issue is financially material if performance in relation to that issue impacts the financial performance of the company. The financial position of the company can be impacted through a number of channels. It can be impacted through the income statements due to changes in revenue or expenditure, or it can be impacted through the balance sheet, through the change in the value of assets and liabilities, and changes in the cost of capital. The next question is, how do we operationalize financial materiality? How do we connect these issues back to the financial performance of the company? Well, one way to do it is to look at the impact of these issues on the value drivers of a business. So the value drivers of a business are sales growth, margins, and its use of capital. So through an understanding of the company's business model, we can understand what are the value drivers of the company and how these are impacted by its performance on non-financial dimensions. So here is an example. We have the value drivers of a highly innovative firm. So we can see that the sales growth and margins of the company are driven by its innovation. The more it innovates, the more customers it has, and the better its products are compared to its competitors, so the higher the profit margin it can sell its products at. So this success is partially offset by the amount of money that the company spends on R&D. So we've identified that one important value driver of this company is innovation. So we might want to measure what is the company's level of intellectual capital. So one driver of innovation is, of course, the intellectual capital of the business. Since we've identified intellectual capital as a value driver for this company, or something that is financially material, the next question we might ask is, how do we measure the company's performance related to it? Well, we can measure the company's stocks or input of intellectual capital. So how many patents does it have? How active is it in research, so the number of ongoing R&D projects, and how research intensive it is, so how much does it expend on R&D as a percentage of its revenue. Also, we can look at the outputs and outcomes of the process by looking at the number of new patents created in a given period, how successful those R&D projects are, or the pipeline success rate. We can also look at relative figures, such as the number of innovations per employee, or the number of innovations as a function of R&D expenditure. So how much does the company on average have to spend to create one new R&D, or how R&D efficient is the company? This will allow us to compare the company with other companies of various sizes. Also, we can ask, of the innovations that the company creates, how many are related to sustainability? So we can see the direction of their innovations with regards to sustainability. Finally, we can see the outcome of the process. So if a company is very innovative and creates new innovative products, this will also improve the brand value of the company. So these are many different metrics that we can use to measure the company's performance on what is a financially material issue to them. And then we can connect these back to the sales growth and the margins of the company. So if the company becomes more innovative, we can say that we estimate that the company's margins and sales growth will increase. And same if the opposite happens. For our highly innovative firm, we identified innovation and intellectual capital as a financially material issue. But we might want to dig a little bit deeper. What drives innovation? Well, one thing that does is human capital. So for this company, human capital would be another financially material issue. So how can we measure their performance on this dimension? Well, first we can measure their strategy and ability to attract a diverse and qualified range of employees. So this is an absolute measure subdivided into different components. So the number of new employees by gender, age, and education level will give us an indication of the company's ability to attract these different types of employees. Then we can look at the ability of the company to keep its employees satisfied. So how happy are the employees? We can measure this in two ways. One is quite direct. Ask the employees through an employee satisfaction survey. The other is more indirect. You can look at the employee turnover rate, which tells you the amount of employees that are leaving. Yeah, it's the number of employees who left over the average number of employees over a given period. So a higher employee turnover rate might indicate that there's something going on in the company that makes employees unhappy and want to leave and find somewhere else, or to vote with their feet. Employee turnover rates can also be looked at on a more granular level. You could look at the employee turnover by gender, age, education level, and so on. So you can go more granular with this measure too. Finally, we can measure the investment the company makes in its human capital with measures such as the average hours of training per employee. So this will give us an indication of how much it builds its human capital internally. So once we've identified the company's performance in relation to these measures, we can relate them back to the value drivers of the company. Thanks for your time and attention. See you in the next unit.